how long can this good mood be sustained? With us to tell us is Tom Elliott, global strategist at JPMorgan Asset Management, where he's responsible for their monthly investment outlook. Tom, really good to see you. I was just wondering just how long this can be sustained.
Morning, Owen. I think we've got to be very careful before assuming that this rally is at the beginning of a full-blown recovery. What we're really going to be looking for is a once-and-for-all solution to the Eurozone debt crisis and some form of political consensus on Capitol Hill that the deficit is not going to be used as a tool, as a political gambit, as we run up to the presidential election.
Yeah, we could be waiting months and months for that, Tom, right?
Which is why I'm suggesting that we don't take today's news as the starting point of a rally. We do not believe there will be a double-dip recession in the US or any of the major global economies. So we're not overly bearish from today's levels. And indeed, when you look at valuations of risk assets, whether spread products or equities, I think there are some interesting opportunities. But I would be nervous about going feet in right now.
Are you rushing into fixed income? We know how popular the treasuries are at the moment. What about corporate bonds as well, though?
Yeah, I mean, it's interesting. There are some very good AAAs out there. Unfortunately, liquidity is not their greatest strength. One of the ironies of being a AAA-rated corporate bond is that you get to that position because you don't have much debt out. So there's a slight problem there. Lower down the scale, yes, you can get some good yields, and so long as we avoid a double-dip recession and profit margins remain high, and unfortunately that does mean labour costs remaining mute, corporate bonds do look like something to put into a fixed income portfolio to move a little to that northwest on your efficiency frontier.
OK, what about commodities? Now, there has been something of a sell-off. Where are the opportunities there? Because we're still seeing a lot of volatility there as well.
Yes. I think with this sudden sort of risk-on day that we're enjoying today, it's no surprise to see commodities rising a little. But, of course, one of the ironies of QE2 was that it was blamed by some for raising commodity prices because of the excess credit that it allowed in developing countries. So it'll be a bitter irony if we get higher commodity prices that translate into, once again, higher food and energy prices for the Western economies, and thereby cutting down household disposable growth.
And we've got this sort of relief rally going on across the world, really, at the moment, yet gold continues to rise. Are you one of these people that say, you know what, give it a few weeks, 2000?
No, because I don't commit myself to hard numbers. But I think what's very interesting about gold is that it's not just benefiting, as the Swiss franc was and the yen, as a safe haven asset. What it's also benefiting from is fabricated demand. Now, every mobile phone, every electronic gadget contains gold. And then there's demand for jewelry in Asia, India and China especially, which supports the price. So it's very difficult to know what is a fair price for gold.
The current price is $1,755. Tom Elliott, thank you very much indeed. Good to talk to you.
Thank you.
Here on Bloomberg Today.